Hello, and welcome to CAP STRAT this week. Let's get right into it. Mike, we can start with market returns for the week ended January 19th. What's been driving markets over the past week?
Difficult week, broadly speaking, for markets last week. There was some green on the board in larger cap growth companies. Primarily, a lot of those gains were concentrated in chip companies, semiconductor companies. And the bellwether there, TSMC, coming out and saying they believe that the chip cycle for demand for semiconductor chips is finally turning a corner. And so that was good news across the industry. So it's really the only gains throughout the week. The other areas in the market had fully priced in this immaculate landing as we came into 2024. And since then, the data has sort of been pushing back on that a little bit. And so you saw other areas of the market selling off. And then fixed income is where the pushback on the idea of an immaculate landing really has hit markets.
Wasn't just data providing that pushback. We had some global central bank speak trying to get markets a lot less expected, in terms of first half rate cuts this year. So, I mean, a lot of red on the board on the fixed income side. I'm going to dive into those comments a little bit more.
The pushback from central bankers was global. It was pretty much universal. Christine Lagarde pushing back on the idea of rate cuts in Europe and also saying that the markets pricing in of aggressive rate cuts are actually making it harder for central bankers to do their job of defeating inflation. And then we saw Fed leadership come out and push back. Mr. Waller and Mr. Bostic, both
voting members in 24.
Both voting members coming out and saying that rate cuts in the first half of the year probably just aren't necessary. And so, it's kind of interesting that they're coming out and saying that now, given the reason why there are expectations for rate cuts is because you all created them. So maybe you just shouldn't have created them in December, but pushing back on that. And what you saw was Treasury yield curves rising, credit spreads widening just a little bit.
Yeah, and like we just talked about a couple of weeks ago, if the Fed wants to cut in March, it'd probably be pretty unlikely that you would have two voting members talking in the second half of January about how inappropriate first half cuts could potentially be.
Correct.
So,
yep.
Interesting note there. We'll wrap up with alternatives. Some more red on the board here. Anything important to note in the alternative space?
Some interesting things going on with coffee and individual commodities, but broadly speaking, not a big week.
Awesome.
Yep.
All right. Well, then we can get into our main topic for the video this week, which is the 2024 U.S. elections. We've been getting a lot of questions around the election, and as we'll talk about in a lot more detail here, we still think it's too early to certainly make any types of predictions around the elections and talk about what that market impact could be. But what we thought we would do here is just go through Q&A style, some of the more popular questions we've been getting, and explain our thought process around handicapping the election and preparing portfolios for various outcomes within the election. So why don't we go ahead and start with our first question, which is, when do markets typically start to focus on the election? We're sitting here 9+ months out. Is it too early?
It depends on what market you're talking about. The first areas of financial markets that start to move and start to price in potential election outcomes are usually derivatives markets. So options, futures contracts, whether that be options on specific stocks that might do well if the probability of a certain candidate winning rises, or options on things like the VIX, say you're trying to protect yourself of some outcome. So we'll probably start to see moves, options bets and futures bets, as we get towards March. That probably seems like a reasonable time period. Then the next place where we would start to see markets price in potential outcomes is usually currencies and interest rates. And it's usually only when we start to get a better idea of what the policies are from the potential candidates and trying to identify sources of overlap. So for example, if it's clear that both candidates have overlap in terms of aggressive fiscal spending, then you would probably, as soon as that became known, which is pretty early, You would see, potentially the U.S. dollar weaken, longer-term interest rates start to rise, and a pretty similar thing within certain areas of the equity market, certain sectors, industries. If there's policy overlap from the candidates, say this particular industry is sort of in the crosshairs, you might see some sell-offs there. But in terms of broad equity markets, which is what most people refer to when they say markets, broad equity markets usually don't start to price in election outcomes, no more than 90 days out from the election. So it is too soon, right? But yeah, usually no more than 90 days out.
Yeah, and that's typically surprising to people when we tell them about that. We talk a lot about news versus noise. You listen to the news cycle, and this is the most important election of all time, and markets are anticipating, the potential results of the election. But our research continues to show that it's a lot closer to the election. But I think a logical follow-up question to that is why? Why do markets wait so long to start to price in the implications?
Well, there's information you have to know first before you start to position for any potential outcome. You need to know the candidates. You need to know their key policy differences. And even then, if you have a good idea of that and you think you can predict that, a candidate might not be able to implement their policies unless Congress shakes out a certain way, right? So it's very difficult. There's a lot of information that's unknown. The market tends to take a wait-and-see approach because of all that. And, of course, predicting the outcomes is just really hard, right? Yeah. So that's another reason.
Yeah, I mean, you talked a lot about, policy overlap between the presidential candidates themselves, but maybe an even more critical factor is the policy overlap between the president and the congressmen and women that are elected from their same party, right? Because there is such a dependence on working with Congress to get a lot of that policy passed.
Yeah, and the news cycle will have you believe right now that every move in the equity markets, depending on what news outlets you want, is based on what's happening in the primaries. And that's just not the case. If you really look into markets, it's just far too soon to see any potential outcome reflected in broad equity indices.
Right.
Yeah.
Right. And so, moving on to our second question, another popular question we get is, well, could this year be different? Right. Mm-hmm. That's always a relevant question. What if this year's different?
Well, this year is unique in a couple of ways. First, we're sitting here in mid to late January, and there already is consensus on who the candidates are going to be. That's rare. It looks like it's going to be Biden and Trump. And if it is Biden and Trump, markets already have experience with both of those presidents. So that is quite unique. Unique in that you could say, because there are sort of two known knowns, if you will, this early, that the market would start to price in an outcome earlier than normal. But you could also make an argument that because, these are known knowns, known commodities, that any market moves wouldn't be that large, right? There's no long shot candidate here. The market isn't leaning strongly one way in a way that it might get surprised on election night at this point.
Yeah.
So it could be a lot of movement within markets, but broadly speaking, look like not a lot going on.
Right.
Right.
Yeah, and not only do you have the idea of the two known knowns with two individuals that have both been president before, but also as we sit here today, the expected outcome of the presidential election is close to a coin flip, right? Mm-hmm. You compare that or contrast that with 2016, right, where you had Hillary Clinton as a relatively known, at least perceived to have been a continuation of the status quo if she were elected. And then you have Donald Trump, who was even more of an unknown back in 2016. But you layer on top of that going into the election, there was a perception that Hillary Clinton had an excellent chance of winning that election.
Right.
And so we all remember that reaction the night of and the morning after when it looked like Donald Trump was going to win it, that there were some swift market moves. Mm-hmm. And I think we just wanted to highlight that we're entering a very different election, certainly as we sit here today.
Yeah, exactly. Trump being viewed as the long shot candidate, the polls suggesting something different, and then him getting elected into a Republican sweep,
right,
which is generally the most extreme outcome, is if you get a clean sweep by one party. And then based on the market reaction to his acceptance speech or his victory speech, it was clear that markets didn't really know how to price in his policies yet. Right? So it was just surprise, surprise, surprise. And that's why you got the volatility. It's going to be much harder to have a surprise this year.
Right.
Especially after 2020. I mean, it's just going to be a lot harder.
Yeah, definitely. That'll take us to our next question here. You talked about the extreme outcomes of a Republican or a Democratic sweep. I think that certainly comes into play here. But which policies or scenarios could be the most impactful for markets?
The biggest things that we'll be looking at and that markets will be honing in on are your fiscal stance of the candidate. So just think taxes and spending, trade policy and geopolitics. And those are known unknowns, right? So you still would sort of have to see them all go in one way in order to get a big market reaction, a scenario, if you will. So at this point, we're looking at two potential scenarios that if they play out, they could be disruptive to markets, especially given our starting point. That's another key element. Right? You get these things to line up in one direction and they exacerbate the current conditions, and that's when markets could struggle. So the first would be, call it an unfunded fiscal expansion. So assuming a starting point of we have above target inflation and we have a runway here where we have a large fiscal deficit already and there's going to be a lot of new longer term treasury issuance hitting the market. And if you got in a situation where this would generally only happen in a sweep type scenario, you get a Democrat sweep or a Republican sweep, where you get an unfunded fiscal expansion, meaning you have tax cuts with no spending cuts, or spending increases with no tax increases. That could be really tough because it would probably increase fears of inflation and fears of an unsustainable path fiscally for the US, which would most likely result in the Fed keeping interest rates higher for longer. And we know right now the market wants rate cuts really bad. And you could see longer term bond yields rise, which we know the equity market does not like that either.
Especially in the growth side.
Exactly. So that could be very disruptive. It'll be interesting to see how soon that starts to get priced in. And we'll be watching that in terms of inflation break-evens, Fed funds futures markets, and then interest rate option bets, moves in the longer term treasury yield curve. So that's definitely one thing we're watching.
Yeah, and the fiscal side, as we mentioned earlier, very reliant on congressional approval, needing to work with both houses of Congress. But another scenario that we're thinking about is more dependent just strictly on the president's actions, and that would be trade tensions, geopolitics. What are we thinking there?
Yeah, if you had a further ratcheting up of tariffs, trade tensions, what would that mean? That would probably be good for the dollar, bad for our trading partners' currencies, if you want to still call them partners after this, but bad for foreign currencies. And so, of course, that would be difficult for any US-based companies that have revenue streams denominated in foreign currencies. If those aren't hedged, a stronger dollar would hurt there. So the market generally views increased tariff activity as it would put downward pressure on global GDP growth. Right? So it would seem sort of stagflationary. And it's viewed right now that a further ratcheting up of tariffs would pretty much only come with a Trump victory.
Right.
So you'll see that start to get priced in if it looks clear that Trump is the likely winner.
Gotcha.
Yep.
Yeah, and speaking of things getting priced in, that's the final question we wanted to address here today. As again, we are still 9+ months out from the election, but what is our process? What things do we look at to try to gauge what could play out?
Yep. And it's key here, you don't want to rely too much on any one indicator, which we know can be difficult. A lot of folks tend to just latch onto whatever indicator says their candidate is likely to win. So we try to be much more unbiased than that. But it starts with us, one, looking at the betting odds. What you need to see in the betting odds is a clear margin of safety, because betting odds can be unreliable. So it's not just enough to say, one party is likely to take the House. You would want to see at least a 5+% margin of safety there to have any confidence in the betting odds. And then we also look at polling data, and that's the same thing. You have to have a margin of safety when you're looking at polling data because it can be unreliable. The last thing, if you're dealing with an incumbent candidate, which we will be dealing with this year, is looking at their approval rating. If it's below 50%, there's only been one incumbent president who's been reelected with an approval rating under 50% since approval ratings have been captured. So that's key. Then Alan Lichtman's keys to the White House. It's a fun process to go through. It's a very valuable tool to use. Basically shows that when folks go to the voting booth, they don't look at it as a choice between two candidates or a choice on the future path of the country. What they actually use their vote for is a referendum on the last 4 years. And it's simply based on what's transpired, am I going to vote for the incumbent party or not? So we'll go through that whole process. And then you have to look at, it's a numbers game ultimately with the Electoral College, right? So you want to go bottom up, state by state, and look at, are these states, solid in one direction? Are they leaning one direction? Are they likely, or are they a toss-up? And that's based on the Cook political report, which is also very useful info, and tally that up and see if it's an uphill battle for one party or the other. And then the last thing is the S&P 500 return in the last 90 days before election night. If it's negative over that time period, that 90% of the time coincides with a change in leadership.
Yep.
So you look at all those indicators in a very methodical way, and you really need to see all of them leaning one way in order to feel confident that you can predict the outcome. So in 2020, these were all leaning towards a Democrat sweep. And so we felt comfortable sort of leaning into that outcome in portfolios. But if it's more of a toss-up or you're getting mixed signals, that's where instead you should just focus on diversifying and preparing your portfolio for a range of outcomes.
Right.
Upside and downside surprises, more of a risk management type exercise.
Yeah. And I think, a number of those factors that you listed speak to the earlier question of why do markets wait so long? Well, some of these things, by definition, we won't know until closer to the election or even the night of the election, specifically looking at S&P 500 return, right?
Yep.
So thank you for walking through that with us. That is our overview of how we think about elections. A lot more to come, as we get closer to November. Let's get into the framework. Okay. Yeah. So we can start with looking at inflation. Inflation obviously been a big topic of conversation. One of the primary factors those global central bankers are using to push back on rate cuts in the first half of the year. Mm-hmm. Any big updates to our inflation forecast?
Retail spending data came in very strong last week. That, on the margin, is supportive of our forecast, seeing core CPI firming up at around 3% this year. Core PCE running at 2.5% plus. And, in that type of an environment, it makes sense that central bankers are pushing back and being a little more patient with potential rate cuts.
Right. On the liquidity front, we talked about last week some major updates to our liquidity forecast. Mm-hmm. Anything to add on top of those big changes last week?
Nothing to add on top of that. It will be key as we get into the January FOMC meeting coming up next week, if they pay any lip service to quantitative tightening. Yep. And then, of course, we'll have to look at the meeting minutes from the January meeting to confirm our view that they're setting up to reduce the pace of the balance sheet runoff and wrap it up by the end of this year, which results in one of the sharpest improvements in liquidity that we've had since 2021.
Yep.
Yeah.
Low bar.
Yep.
Yeah. All right. And we have talked about, if changes to the policy rate, the Fed is going to want to telegraph those well in advance, almost, get approval from the market before moving. Is our view there the same from a quantitative tightening perspective, that they would want to forecast that move and get the market ready for any type of change in policy there as well?
Absolutely. And the market will be ready for them reducing the pace of the balance sheet runoff. That's for sure.
Ready?
Won't be hard for them to get on board with that.
Awesome. And then economic growth, any updates to our economic growth projections here?
This week, we're going to get the first look at Q4 US GDP, and based on the retail sales data that we received last week, it looks like that data is going to be 2% plus for Q4. So once again, beating expectations, and pretty soon we'll be turning the page and looking at nowcast for Q1 GDP growth, which as of right now looks pretty solid as well. So, economic growth data continues to be a little better than expected, and that's a big reason why you see, for example, Waller from the Fed saying, if the labor markets are tight and the economic growth data is fine, I see no rush to cut rates.
Yeah, just another item on the side of pushing back on rate cuts, right? And then our last item within the investment framework, recession signal remains inactive. Anything to note here from a recession signal perspective?
No, overall, still very benign. I mean, obviously, if we see any stress in the labor market or we see any market stress, we know the economy is vulnerable, especially if it happens when the Fed is pushing back on the idea of rate cuts. Right. But it's not active right now. So
hasn't happened yet.
Yep.
All right. Well, that'll do it for our video this week. If you have any questions or comments, please continue to reach out, and we will get back to you. Thank you.